Brent crude is up 59 cents, while West Texas Immediate rose 58 cents today. This comes after 2 days of decline as investors continue to monitor developments in Venezuela. For more on this, we're joined by Rob Thummel, Senior Portfolio Manager at Tortoise Capital. Rob, thank you for joining us.
Thanks for having me.
Is this kind of a return to normal for oil after the shock of Sunday?
Well, I think so. I think obviously, the fundamentals of oil, the physical fundamentals really haven't changed if you think about it. We still have an oversupplied oil market, global oil market. So as a result of that, we continue to see, pressure on oil prices, and you see that in the futures curve as well. What could send oil prices higher? Well, there could be a disruption in the infrastructure, oil infrastructure. In Canada just as well as I do here in the U.S., oil infrastructure is really important, and so we don't see that happening in Venezuela right now. But if you took Venezuela oil off the market, then that would be a lot of barrels, probably about 1 million barrels off the supply, and that would help balance the markets a little faster. We don't think, though, on the opposite end, that Venezuela is just going to flood the market with oil. They're not just going to return to producing the 3 million barrels or whatever that may be that they have produced in the past, because the oil infrastructure, the oil fields need a significant amount of capital investment, and that's going to require years, not months or days, before Venezuela can become a more prominent source of oil and more of a global oil producer in the future.
And just short term, with the president saying that they were going to take 30 to 50 million barrels from Venezuela for use in the U.S. What kind of a factor have we seen? Any details on how that will be coming into the system, or what kind of an impact it will have?
Well, the only detail I've seen is I assume they'll probably take it to the Strategic Petroleum Reserve in South Texas, and some of that oil is not all of that oil, but some of that oil is already loaded onto vessels ready to be transported, and so that will likely end up back in the Strategic Petroleum Reserve, and so that's what I think. Obviously, as you know, we've been drawing down the Strategic Petroleum Reserve in the U.S. over the last couple of years, so it's likely we'll fill up the Strategic Petroleum Reserve with this heavy oil, like Canada produces as well. That's really important to the U.S. refining system and and U.S. energy in general.
And what kind of a reaction down in the States has been with Canada? There's obviously a lot of oil flowing south. Have they talked about that? Are they thinking that maybe they'll see the oil start coming up from the south instead of coming down from the north?
Yeah, no, that's a good question. You saw the stock reactions. You saw some of the Enbridge, who's obviously a fantastic company that does, but has oil transportation. It was down. Some of the Canadian oil sands producers were down earlier this week on anticipation of, obviously there being competition and more oil, heavy oil per se, coming from Canada. The way we look at it at Tortoise is, look, we think low oil prices will result in increased consumer demand, both domestically and globally. And more heavy oil basically just means ultimately lower gasoline prices here in the U.S. And so that probably isn't a bad thing. It's probably a good thing.
Okay, and let's talk about what some of the likely drivers are going to be. AI, it sounds like, and the build out, right?
Well, yeah, longer term, yeah, from an AI perspective, we see a tremendous opportunity for natural gas, and we need a lot of natural gas. We've got a lot of natural gas in the U.S. There's a lot of natural gas, as you know, in Canada as well, and that's a great thing because AI is going to result in a significant increase in electricity demand, and you need a fuel source, and you need a cheap fuel source to power that. Natural gas is the answer, and it can help the U.S. win this global AI race because natural gas is a low-cost source of electricity that keeps electricity prices low. So we're excited about that longer term because of the large supply of natural gas in the U.S., but in Canada as well.
And I've seen some reports that natural gas is expected to jump this year.
Well, it could because of the demand, but remember, it's so weather really depends on what happens with the weather, and so we don't expect to see a substantial rise in natural gas prices, frankly, unless there's some weather event, some polar vortex or something along those lines, both domestically or globally. But there's a lot of supply of natural gas here in North America, and that'll help keep prices, natural gas prices in particular, at reasonable levels.
And where are some other places then people should be looking with the power expansion, natural gas, but what else? What other opportunities are there?
Nuclear is an option. I mean, we think there's some options in nuclear with the power expansion as well. Pipelines are a fantastic way to get exposure to AI, but you don't have to pay the multiples that you pay to buy mega cap tech, right? And it seems that seems rather odd to say pipelines and AI, but if you think about it, if natural gas demand is going to rise, you're going to have a lot more volumes flowing through all of these pipelines in the U.S. and Canada, and that will allow for a lot of these pipeline companies to continue to pay their existing dividends, grow their existing dividends, and buy back shares. And yet, like I said, these stock prices are much cheaper than buying mega cap tech. And their growth rate's not maybe the same as mega cap tech, but they're still solid companies with great dividends, great growth rates, and have this maybe it's a tsunami, maybe it's just a large wave behind them in terms of AI supporting their business models for the next several decades.
And can they handle that growth? Is there room for that?
Yeah. Oh, yeah. No, you're gonna see demand for natural gas, especially continue to grow. When you've got electricity growing at 2 to 3% a year, and that seems small annually, but when that compounds, that's a lot. You need a lot of terawatt hours of electricity, which means you need a lot of fuel supply source. You need a lot more natural gas. And then obviously the exports too. Obviously we haven't even talked about that, but energy exports, LNG exports, both out of Canada and the US are going to increase as well. So we see natural gas as a great place. We've been investing in energy for 30 years or 20 years at Tortoise, 20 plus years at Tortoise, myself personally for 30 plus years. And natural gas is in a really good spot right now for the next several years, if not decades, because of the low cost nature and the large amount of supply we have in North America.
Okay, we'll leave it at that, Rob. Thanks very much for joining us. I appreciate it.
Thanks for having me.
Rob Thummel is Senior Portfolio Manager at Tortoise Capital.